Hey, this is Chris. Now, one of the more common questions we get from our clients, particularly around tax time, is around franking credits. It sounds pretty complex, but in this video, I'm going to try and explain in a very simple way what franking credits are, how they work when it comes to claiming tax, and actually how it impacts the Australian share market. So, first of all, a franking credit, which is also known as an imputation credit, so you might often hear of it termed that way as well. It represents the tax that a company has paid on profits in Australia already. So, in Australia, when companies pay dividends, they're typically paying dividends out of money that's already been taxed. And so when you receive a fully franked dividend, it means that the company has already paid tax on the dividend you've received. Now, to avoid having to pay tax twice, what you get is both the dividend and also what's known as a tax credit or a franking credit to basically give you that tax back. So what it means is if you're on a high tax bracket and you received the dividend and the company has already paid 30 cents in the dollar, which is the company tax rate on the profits, you may only have to pay another 17 cents or something like that on your dividends. So it reduces the tax impact on dividends getting paid out in Australia, and ultimately means that if you're receiving dividends, the company's not paying as well as you're only having to pay once in combination. So it's a bit of a unique tax structure in Australia. There's been a lot of debates over the years as to whether it's fair or not, or how people abuse or misuse this system, because there are certainly ways to claim franking credits even for people that aren't paying tax, which some people think is unfair, but others think it's pretty reasonable. But ultimately, that's how it works. The concept is that you shouldn't have to pay tax twice. So if a company's already paid profit tax, then you should only have to pay the difference between your marginal rate and the company rate on any dividends you receive from that company. So that's the very simple explanation. How does it impact companies in Australia? Well, what it means is Australian listed companies, and particularly the biggest 100 companies in Australia, they tend to pay much higher dividends than other companies around the world because of this tax freebie that they're also able to hand out to investors. So what you tend to see in Australia is the dividend yield of our share market, which is how much dividends our companies pay relative to their prices. It tends to be quite high relative to other countries because of this nuanced tax system around franking credits. Is this a good thing or a bad thing? Again, I think that's up for debate. A lot of retirees in Australia and self-managed super funds love franking credits, particularly if they're on low tax brackets because they're already in that retirement drawdown stage. They're able to earn the dividends, of banking companies in Australia and others that are making most of their profits here, and also receive a franking credit, which means that their gross dividend they receive, or the dividend plus the franking credit, can often be upwards of 8 or 9 or 10%, which is a great yield or a great return on an investment. On the downside, I think there's also a negative side to all of this, which is that Australian companies, because they are so beholden to their shareholders who want these high dividends, they end up having less money to invest in their own businesses, into R&D, into innovation, into creating new products and services. So, and this one is harder to really validate. My theory is that Australian companies tend to be a little bit less innovative, particularly the large companies, because there's a lot of shareholder pressure for dividends. They're actually unable to invest within their businesses as much as their overseas counterparts, and this may actually set our economy a little bit further back when it comes to innovation and productivity growth. So if I was to be recommending something to the government, it would be to really be considering franking credits as a whole, both the benefit from an investor perspective, but also what is it actually doing for our economy? Is it actually making us more productive? Is it making us more innovative? Or is it setting us behind the rest of the world? But overall, investors love these things, and that's how franking credits work in Australia.